If you looked at markets like the Shenzhen index, that had got to a PE of over 40. It had gone up 200% in 2 years. The Chinext index, the sort of medium tech-type companies, were on PEs of over 100 times on average. These companies were in a bubble. They'd risen significantly, and they needed a setback. We've got some bizarre reactions. The fact that half companies now have asked for their shares to be suspended so that they can't see the fall, stopping people from selling shares, all these sorts of things are bizarre reactions to what should be a proper market setback.
China's markets are still pretty much separated from world markets. They're obviously moving towards being more integrated, but right now they're not. So you're not going to, I don't think, see the direct linkage there.
Obviously, if something untoward happened and the market dropped, another 30 or 40%, and the economy suddenly ground to a halt, we could start to sort of express concerns about how that might spill over to other financial markets and to the global economy. But I mean, as things stand at the moment, I think the risk is minimal.
How low interest rates can go, right? They dropped from 5 all the way below 2% in the front end of the repo rate curve. And then the question is how much lower this can go. Once you combine those two things, it triggered investors to say, hey, let's wait for a second and see what's next.